Hello, everybody, and welcome to HardAssetsInvestor.com. I'm Mike Norman, your host. Well, what about gold? Last week, experiencing the largest decline in over 30 years. Here to discuss that is my guest, Jeffrey Christian, who's the managing partner at CPM Group. Jeff, welcome back to the show. I appreciate it. Now, you really follow the metals markets. Your company is very much involved in those markets. Tell us what your view is now, given the big decline that we saw over the last couple of weeks in gold, dropping, had the largest decline in over 30 years. Is gold finished?
I don't think gold's finished. I'm not sure what that means. You know, life goes on. Our expectation, we had been thinking that the gold price could fall to 1430, and actually, I guess it got down.
And you
to,
said that. You said that on this very show. I
Right.
remember, and that was back. I think we maybe were at about 1700.
Yes.
That was a way extreme call at the time. So.
Right.
Kudos on that one.
It's based on economics and fundamentals. It's not based on any conspiracy theories or technical analysis. It was really based on the fundamentals of the gold market and the macroeconomic environment. Having seen the sell-off now, what we're seeing is a lot of people coming in as bargain buyers, bargain hunting, and they're buying. They've taken the price from a low around 1320, 1330 a week ago up to about 1400 today, as high as about 1430. Our expectation is that gold will probably consolidate between 14 and 1450 for a while. Investors will continue to buy for a while, and you'll see the price stabilize in that range.
Now, what caused it? I mean, you hear all kinds of crazy stories. You hear these conspiracy theories flying around that it was central banks, got together and started selling gold. I mean, what caused it, in your opinion?
One of the big misperceptions, I think, or misconceptions, is that the physical market was buying and the paper market was selling. And if you go back 2 weeks ago, the price of gold was around 1550. It had already fallen significantly from 1680 at the beginning of the year to about 1550, 1575, and it wasn't rebounding. So people took that as a bearish signal. And in that time, 2 weeks ago, no one was buying in the physical market or the gold market. At that time, you had the Bank of Japan saying they were going to double money supply in 3 years. You had the ECB saying Ireland and Portugal could take as long as they wanted, 7 years or even longer to repay. You had a number of monetary and fiscal authorities around the world saying austerity is not working. Let's really get serious about printing money.
You had the North Korea situation.
And you had the North Koreans threatening nuclear attack on South Korea, and no one was buying gold. So you were sitting there at 1550. The price was down. It was just dormant, and no one was buying physical or paper gold. And in that kind of environment, those people who have a proclivity to go short said, if gold's not going to rise in this environment, I'm going to go short.
What's going to make it rise? Exactly.
So you saw a wave of short selling in gold, and you saw it in silver, and they started taking out stops. And as the price got down below 1530, which was the base, we touched 1530 3 times from the high in September 2011 until last week, and each time it bounced off of 1530. When it broke below 1530, there was this wave of liquidation orders and fresh short selling that came into the market. That took it below 1500, took it below 1480, and you just had the price cascade down. It lasted for 2 days. Once the shorts were as short as they dare be, and the longs had pretty much liquidated any long positions, the stale bulls that were nervous, once that selling and short selling was out of the way, the price stabilized, and you saw physical buying on a bargain hunting basis. All those people who would not buy at 1550 the week before were ready buyers at 1320, 1330, 1350, 1400.
Right.
And we've seen the price come back over 1400.
Now, commodities usually exhibit this tendency of mean reversion, right? They'll spike up for a while, but then eventually they come back down around, the average cost of production. Where are we now at 1400? Where are we in terms of cost of production? Like it's probably varies a lot, but I mean, are we close to where high cost producers are maybe breaking even right now? Do we have to go lower? Are we already below that?
The gold, if you look at the cost curve of gold producers, probably 90 99% of gold production comes in at prices below $1,200 on a cash cost basis. When you put in a full cost basis, you're getting pretty close at $1,400. You're getting pretty close to the marginal producers. You do have a few 100,000 ounces of very high cost production above that. So you're getting close to the high end of the cost curve. You know, we don't put a lot of credence on the cost curve because you can see gold, copper, oil go way below the marginal cost of production for long periods of time. So, you know, we don't think that the marginal cost production is a short-term support level. From the long term, 5-10 years forward.
I mean, you see it very clearly in a different market, natural gas, where we got down into 2-handle, which is way below the vast majority of the industry's cost of production. It's still down below where most of the industry. So, you know, I was talking to another guest that we had on recently, and also we're talking, you know, historically the behavior of commodity prices. You could have long periods of basically stable prices, and then some supply or demand shock, which knocks it up to another plateau, and then it stabilizes again there. Do you think that's where we are now for gold and silver?
Yeah, we're kind of looking for gold and silver prices. Yeah, we were looking for $1,400 gold. Well, we got it. You know, and that was our long-term low that we thought we might see in 2014, but we got it, you know, in the first half of this year. So we're looking for gold prices to basically trade sideways for the next couple years. And then at some point start moving higher. And it'll move higher for a combination of fundamental reasons. Producers need higher prices. With lower prices, jewelry demand will start reviving. And much more importantly, for economic reasons. You know, for the next couple of years, you may see the economy sort of move sideways. Subpar growth, relatively low inflation, low interest rates. But by 2015, 2016, you may see the formation of another economic shock that would cause investors to say now it's time to start buying a lot of gold again, and that could drive the price
in
up.
Terms of a negative shock.
Negative economic shocks.
What do you make of, you know, the big, I mean, almost like a complete takedown of the austerity doctrine with the exposing now of the famous paper by the Harvard economists Carmen Reinhart and Ken Rogoff, where it was found out that they made, you know, really serious errors in their research. And now you're starting to see major financial players, Goldman Sachs, Bill Gross of PIMCO, and others come out very openly saying austerity is a failure. Do you think if we start to move away from austerity as a policy, isn't that bullish for gold?
It is bullish for gold in both the short-term and a long-term basis. You know, at the risk of sounding like I'm crowing, let me say I gave a speech at the World Bank in March of 2009, in which I said one of the biggest risks to the economy on a long-term basis was that the industrialized world would introduce austerity measures too soon. And you saw the British do that in 2009 and throw themselves into a recession right away. Other countries were slower in moving that way, and what they've done is they've strangled growth and they strangle the recovery. What you need is, you need stimulus now on a short term, but you also need to be able to project long-term credible plans to deal with the deficit problems in the United States, Japan, and Europe. And they're not producing that. They're just ignoring it. And the fear that we have as economists is that what you'll see is that, well, okay, austerity is not working and maybe these deficits don't matter, which is true in the short-term basis. But you shouldn't project that into the long-term basis. What you have to say is, look, we need to have less austere fiscal policies now. Get us out of this, but on a long-term basis, we definitely need austerity. And the risk is that they're going to throw out the long-term austerity requirements because it's not working on a short-term basis.
I'm not surprised that the World Bank didn't listen to you, or if you were even speaking in front of the IMF or any of those institutions, because they never listen to sane, rational arguments. Anyway, Jeff, it's always great having you here. Thanks very much.
It's good to be here.
That's it for now, folks. This is Mike Norman saying see you next time. Bye-bye.